of the Luthold Group. As we look ahead to 2018, Jim, here's the thing. I get all the bullish arguments. You got the momentum. Earnings growth is good. Global reflation. The Fed is, drawing down their portfolio, but not by that much. However, the big variable it seems we have not talked about are rising interest rates, not bonds, but Federal Reserve's lending rate, which is obviously expected to go up even more. Is that the biggest risk to the market we're not talking about?
Well, I think it is interest rates, although I think it's real problematic if the bond market does in fact get involved, Brian. We've been hovering all year around that 240-ish kind of 10-year bond yield, and if it finally decides to reset, then I think it will be a challenge for the equity story. We're right now at a let's say a 240 10-year. It connotes lower for longer. But if you go up just, 25 basis points, 25 basis points, you're going to be at a fresh 3.5-year high in the 10-year yield. And suddenly, 25 basis points higher, the yield connotes the secular bond bull is over. And I do think we might have a shift in focus from Washington tax policy and the economy and earnings doing better to focused on overheat, inflation, is the Fed and bond vigilante behind the curve, and can the stock market, which now trades at 20 times forward one-year earnings, handle a bond yield, let's say, going from 2.5% back to 3%?
Can it? Answer your own question.
I think we'll get through a reset. I think we've got to reset the 10-year yield above 3% for the balance of this recovery. And I think as we do that, it's going to be a challenge for stocks. I expect a correction next year is likely, but I don't think it's necessarily the end of the bull. I think it'll be scary, but I think it might represent another really good buying opportunity for another leg sometime, let's say 2019 or beyond.
I think it was this Bank of America Merrill Lynch had a note out that if stocks outperform bonds this year, which they clearly will, it'd be the eighth straight year, which has not happened since 1928, and only the second or third time it's happened in 220 years. Does that worry you at all, those kinds of massive historical analogies? Also, 28, not the best year you want to be comparing anything to. Just throwing that out there.
That's true. Well, I think, the thing you have to keep in mind with that comparison is that it also underperformed bonds by almost a record amount right ahead of that during the 08-09 crisis. So some of that was catch up. I really think that one of the problems, Brian, is that we are losing one of the major foundations of this bull market, one of the consistent positive forces, and that is a widespread, generalized, constant fear of the future. And that fear is giving way to, I hate to say it, a little bit of optimism for the first time in this recovery. Confidence is at record highs for the recovery. It's broad-based. The global economy is doing better at the same time than ever before. Earnings are coming up roses. And in some sense, the problem for 2018 is the news is just too good, which means that it's doubtful that it's going to get a lot better and surprise people on the upside, but it could come in a little worse and disappoint. And if you put that together with a need to reset rates because, let's say, wage inflation finally does break 3%, then I think that combination of a little disappointment on economic surprise and higher yields is going to create somewhat of a mini panic. And for those that are conservatively positioned going into 18, I don't know when that'll occur or for what level, but if it does and you've been conservatively positioned, then I think you'll have the opportunity to buy on other people's panic.
If I had to bet on technology stocks, which are red hot this year, versus oil stocks, which have come alive lately but squandered a lot of investor money at the beginning of the year, what would be a better bet, oil or technology?
Well, I like the energy side of that bet, and it's a hard one because tech's going straight north. What I like about that trade, Brian, is that energy right now represents the contra tech play. Tech has all the price momentum in the stock market, positive price momentum. It's got sexy unit growth. It's very popular. It goes up every day. Oil couldn't be more the opposite of that. It has no price momentum. It's clearly out of favor, contrarian, beat down. The only thing you could say is maybe it's better value. But I think going forward, there's a catalyst for the energy industry. The crude oil price, WTI, is $3 to $4 from a 3.5-year high. And I think if it breaks into those levels, it'll create excitement about that industry again. And I like its undervaluation. By our estimates, crude oil stocks are now about 32% undervalued, the deepest they've been in this recovery relative to the price of crude oil. And if you change that dynamic a little bit, there could be a lot of funds coming from high growth, high momentum technology back into the under-owned energy sector.